Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Bloomberg learns US car makers are making a last-ditch effort to avoid tariffs on low-value auto parts. Donald Trump's reciprocal tariffs plan set to be announced tomorrow in the White House Rose Garden.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Volatility ahead. Asian shares gain, snapping a multi-day sell-off amid looming trade uncertainty. US futures, though, drifting lower after closing out their worst quarter since 2022. Plus, a 5-year ban on running for office for Marine Le Pen. President Trump expresses support for the French far-right leader, calling her conviction a, quote, big deal. Good morning. So after the sell-off on European stocks yesterday, some modest stability. But for how long? Given that announcement, 3 p.m. US time in the Rose Garden on Wednesday from Trump on those reciprocal tariffs. European futures pointing to gains of 0.3%. Here in the UK, the FTSE 100 looking to add 33 points. S&P futures, after the volatility of yesterday, dropping at 1.7% before ending higher with gains of 0.6%. That volatility in focus. The VIX rallying for the last 4 days in terms of an expression, of course, of that volatility. S&P futures now pointing low by 0.3%. NASDAQ 100 futures pointing low by 0.4%. For the context as well, the superlatives come thick and fast for the most recent quarter. The worst start to the year for US stocks versus the rest of the world since 2009. The Mag 7 grouping of tech stocks falling 17% since the start of the year. Let's flip the board and have a look cross-asset then. The benchmark 10-year yield, we know that's in focus, of course, for the US Treasury Secretary, back below 420, now at 419. Relatively stable at the moment, but we'll see to what extent that holds as we lead up to tomorrow. Euro-dollar at 108, currently resilient around the single currency. Worth noting that's been the worst start to the year for the dollar since 2017. Brent at $74 a barrel, close to 75. Gold at a fresh record high. We seem to say this almost on a daily basis. The yellow metal at 3,114 per troy ounce. 3,114, up 0.6% in the session so far today. Let's cross over to Asia, where the markets are faring a little better today. Avril Hong in Singapore with a breakdown.
Yeah, Tom, it's a Tuesday turnaround. Maybe markets are optimistic that Trump, when he speaks at the Rose Garden, is going to be very nice or even lenient. But these gains to some in the Asia markets look unconvincing given the extent of the declines on Monday. Remember, we saw the region's benchmark at one point hitting the lowest level since early February. And some of these moves, this outperformance in the South Korea, Taiwan gauges is idiosyncratic. We have the Hanwha group of companies, for example, after some of these succession fears were allayed. Those companies are those that are outperforming in Taiwan. Some merger talk between global foundries as well as United Microelectronics lifting the chip-related stocks there. So keep that in mind. Flip the board again. Take a look at Chinese stocks because they are managing to snap a bit of that decline, helped by tech. Tech is actually lifting the region's gauge today overall. But keep in mind that when it comes to the data, even as we see the Tyson factory activity better than expected, echoing what we saw in the official print a day ago, our economists have flagged that there are seasonal factors at play here. So maybe don't read so much into it. And then keep in mind that when it comes to the pain in the property sector, still quite pronounced. We saw a slump on new home sales. Flip the board again. I think the tariff overhang also continuing to weigh not just on markets, but look at the reaction to the RBA, leaving things unchanged, but also flagging inflation control and geopolitical uncertainties, calling it pronounced. And even the comments from the RBA governor a short while ago, not quite feeding into what traders wanted to see in terms of dovishness. We're seeing the Aussie dollar extending gains, and that outperformance is coming along with what we're seeing in the Japanese yen's climb today as well. Tom.
OK, Avra Hong in Singapore on the check on the central bank action of Australia on turnaround Tuesday, at least for now, as we lead up to the tariffs out of the Trump administration. Avra, thank you, joining us out of Singapore. Talking of which, let's get more details, because President Trump is set to unveil, of course, his so-called reciprocal tariff push during an event at the White House Rose Garden tomorrow. So that's the aesthetics. The announcement is expected to feature so-called country-based tariffs with we're told, no exceptions or exemptions. We'll see what the reality is, of course. Speaking to reporters, Trump dismissed concerns that the levies could impact relations with Washington's allies.
Are you concerned that this move, the tariffs this week, could push some of the United States' closest allies to work with China?
No, I'm not worried about it. I'm not worried about it. Yeah.
Mr. President, can I ask you
I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs because, they've been unfairly tariffing the United States for years.
Let's bring in Bloomberg's Oliver Crook for the latest. Ollie, there's still a lot that we do not know about what exactly is going to happen tomorrow, but we do have at least some details. Talk to us about what to expect as we understand it so far.
Yeah, Tom, let's get through what we know and what we don't know. What we do know is that we now have that official timing for that press conference out of the Rose Garden, where we will get all of the details that have been teased really for months from the Trump administration. These massive tariffs, sort of so-called Liberation Day, where he's trying to sort of right the trade balance that he has seen as a great injustice really for many decades. Trump has talked about this, but really has been the sort of main crusade, or one of the main crusades of his political career. So what we're going to get tomorrow, we understand the thing that is priced in already is about that 25% tariff on auto tariffs. We expect to get tariffs from the pharmaceutical industry. What we are all looking for detail on is this concept of the reciprocal tariff. What does he mean by it? Is it just getting basically to a state where you basically match the same levies that we're seeing from other countries? Or does the Trump administration take a much more expansive view on this? Is it something that they can also use as a tool to try to right imbalances that they see in terms of value-added tax, as potential digital taxes? All of these things are going to be very sort of front and center for the sort of EU policymakers who are still waiting to basically have their own response to what the Trump administration has done. They're sort of holding back because they don't really know what to expect. They tried to go to Washington last week to have some negotiations. The Trump administration made it very clear that they're not really interested in negotiating before these levies. So we're going to hit these levies. They're going to come into force basically on the 2nd. They're going to start to be collecting money on those on April the 3rd. And then you could get a whole new set of tariffs beginning on May the 3rd. This is another conversation that's going on with the Trump administration as well. So really tomorrow is going to be an absolutely crucial day. And of course being watched closely, yes, by EU policymakers, but also by the markets that are really taking the sort of been rattled by the sort of action and the reality now of the Trump administration tariffs coming into play.
And Ollie, in terms of the particularities and the specifics around one sector, and a sector that you know very well, of course, sitting there in Berlin, is the auto sector. And we're hearing that there's some last-minute lobbying going on from some of the key US automakers, it seems, largely the US players. What is this fun? Is it too little, too late? What are they calling for?
So listen, I think that with the Trump administration, there have been some concessions made in the past to the U.S. auto sector, right? There's not been a huge amount of tolerance, I think, for international automakers and what they want. But the U.S. automakers, what they're asking for, remember, they got an extension from the Canada tariffs and Mexico tariffs initially. What they would like to see is basically less valuable parts of the car, components of the car, not engine blocks and these sorts of things. But we're talking literally about the sort of wrapping around, the rubber wrapping around wires and these sorts of things. This is what they'd like to see exempt because all of these input costs, and that really speaks to the complexity of the car. And they'd like to see basically those excluded from the tariffs while still getting to the point where you're getting basically the general goal of the Trump administration, which is to get more manufacturing in the United States. And we should say that this comes in the context now of the average price of a new car in the United States reaching close to $50,000. That's up 21% over the last 5 years. And that is something that is obviously front and center for these auto manufacturers who already have been struggling to be competitive with sort of the likes of international companies with their labor costs. Again, this is the Trump administration's big sort of push to try to right that balance. But again, the industry wants to have that balance potentially righted without basically totally destroying their market. And that is basically the concern that they're trying to address here. The average cost of a new car in the US is $50,000. Wow. Oliver Crook, thank you very much indeed on the lobbying campaign.
48,000. Yeah, we can round it up. 50 grand. I mean, it's going to get there quickly, isn't it? Ollie, thank you very much for the latest in terms of one particular lobbying effort coming through in the broader picture when it comes to what to expect from the Rose Garden tomorrow. Now, it was a quarter to forget for US stocks. Here to break down some of the highlights or lowlights, depending on where you sat in this trade, is Bloomberg's Valerie Teitel. Valerie, talk us through just how radically the market shift has unwound the initial Trump optimism.
Yes, it has been quite a bruising quarter for U.S. stocks. It's worst performance for the S&P 500 for a few years. But thankfully, Tom, maybe some good news is that the quarterly rebalancing flows yesterday were quite positive for the equity market. The S&P 500, after opening up down nearly 2%, ended up in the red, up 0.5% yesterday. So those quarterly rebalancing flows helping boost stock, helping boost risk sentiment, and snapping those 3 days of losses for the broader index. But the first quarter scorecard for the equity market was not very nice. U.S. equities, if you compare them to the rest of the world, had their worst performance since the global financial crisis. This outperformance of the rest of the world versus U.S. stocks is not something we see very often. Also, outperformers of the quarter being the Euro Stoxx 50, that defense rally really lifting equities across Europe. And lastly, we got to mention the Hang Seng, the deep-seek rally of Q1, also boosting Asian shares. The Hang Seng in U.S. dollars surging more than 15%. But, Tom, I have to add one more to this, and that is gold, continually hitting new record highs day after day. On the quarter, it rose 19%. It's its best quarter since the 80s, Tom. We continue to hit a fresh record overnight. The yellow metal up 0.6% to trade now very close to 31.50.
Yeah, and our team on MLive, Jake Lloyd-Smith, writing that there is further to go for the yellow metal. No reason why it can't continue to add to the continued records that we've seen. Bloomberg's Valerie Teitel with the breakdown in the markets the last quarter, and of course where some of the gains have come through in terms of that safe haven look. To the politics of France right now, what a decision and what an outcome then, because French far-right leader Marine Le Pen has lashed out at the decision to bar her from running for elected office for 5 years. Le Pen and her National Rally party were found guilty of embezzling more than €4 million of EU public funds to finance party operations in France. She's told French television the decision effectively eliminates her from the 2027 presidential race.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear. I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Let's get the latest now with Bloomberg's Caroline Connor in Paris, of course, who's been following all of these dramatic events for us on the ground. Caro, what else has the leader of the National Rally, Marine Le Pen, been saying on the result that has come through from the courts in France?
Tom, you saw these pictures from earlier in the day yesterday when she was leaving the courtroom early before the verdict was pronounced. She looked exasperated at the judge's ruling. And when she came on TF1 last night, the soundbite that you just heard, she looked different. She looked very combative. She had the look of someone who's not going to give up, even though, of course, for many out here, it also means denial. She said she was very far from leaving the political scene, that it was a disastrous day for French democracy. She repeated that the court ruling was a political decision. You heard the word biased. She said the judge clearly wanted her from the beginning to ban her from running in 2027. When the case, in Marine Le Pen's view, is just some sort of administrative disagreement without any personal enrichment. And when asked whether Jordan Bardella, the current president of the National Rally, was a plan B, Marine Le Pen said he was a great asset for the party, but they didn't want to use this asset too early, too soon, clearly meaning that at this stage she wasn't seeing him as a replacement for these next presidential elections. Her very thin hope, a very thin chance of running is that, of course, she's going to appeal. Usually an appeal in France takes 18 months to 2 years. The presidential elections should happen in April 2027, so in just 2 years from now, and she can register as a candidate up to 1.5 months before the first round. So she still hopes there is a tiny chance that the appeal could possibly take place before the elections.
What other reactions have we been hearing, Caro, from domestically and internationally as well to this verdict?
You know, Tom, there was a sense of sideration across the political spectrum in her camp, of course, but also outside her camp here in France. Even some politicians from the center-right saying they didn't really understand why she wouldn't be able to run. Of course, Macron's line was very much, we follow the judge's decision, we have to respect the justice, she's a citizen just like any others. We had a lot of international reactions from abroad, interestingly from Donald Trump, who kind of compared himself to Marine Le Pen, saying it was a big deal and it kind of reminded him of his country, because there is a little bit of a Trumpification of French politics at the moment. She's playing the victim, and remember, Donald Trump still managed to get a second term, even with a flurry of criminal cases against him. We had a lot of international reaction, of course, from the far-right leaders across Europe. We heard from Geert Wilders, the Dutch far-right leader, saying he was shocked. And in Hungary, the Hungarian Prime Minister posted quickly on Twitter, "Je suis Marine."
OK, the Trumpification of French politics. Bloomberg's Caroline Conan in Paris with the latest. Thank you. Coming up, as traders try to position ahead of Trump's so-called Liberation Day, we're going to discuss tariffs, market positioning, and get some analysis. Stay with us. This is Bloomberg. The Trump administration's mixed messaging then on what new tariffs will be unveiled on Wednesday and how they'll be announced has, of course, traders struggling to position ahead of one of the biggest unknowns in recent months. For a gauge in terms of how to position amid all of this uncertainty, let's bring in Frederique, Head of Investment Strategy at RBC Wealth Management. Frederique, good morning. Thank you for joining us. What assumptions are you and the team at RBC making about the tariff plan of Wednesday, whether or not this will be a clearing event or just adding to the uncertainty?
It might be a bit of both. I think we do expect some fairly large tariffs to be imposed on April 2nd or shortly afterwards, with the hope that they will be scaled back within 6 months after successful negotiations. And the messaging around the tariffs is going to be very important to dictate the reaction of the market. If comments surrounding tariffs are benign, we could very well see a relief rally, given that so much of the bad news is discounted in prices. However, if the threats are more menacing and suggest there is more to come, there could be a further leg down in markets if, in particular, reciprocal tariffs include an element of VAT tax. That would be really the worst case scenario. And we could see the market reaction against that.
OK, so there is a possibility for a relief rally, given how much pricing has been adjusted around the tariff threat. What, though, Freddie, would give the markets the ability to sustain or at least return to a rally that is sustained? What ingredients would we need to see for that?
Well, two ingredients. Basically, one is a scaling back of tariff threats. And the other one is something that the market can't really discount quite yet, but it's being closer to the midterm elections, because all this orchestrated uncertainty is fine at the moment, early in President Trump's term. However, as we approach midterm elections, we do need to have the economy back on track. We do need to have a quieter time. So the market will just have to go through this period of uncertainty and hope it's not too negative.
Are you finding assets, Frederique, that are being mispriced? Are you finding opportunities that are arising as the tide kind of goes out on some of the most popular trades?
We think it's very important to be very agile and look for market dislocations. One area which is of particular interest to us is Japan. Clearly, the momentum has gone out of that trade, but we see that valuations are attractive, earnings are coming through, and corporate reforms are also underpinning earnings. So for us in equities, it is our main overweight. We prefer to have neutral positions elsewhere because that gives us, at a time of great uncertainty, it gives us a lot of flexibility to take advantage of these dislocations. I would point out that there are other ways also to get performance, and one of which is to really truly diversify, so reach out for asset classes which are not linked to the business cycle, such as, for instance, long-short commodities strategies, where many commodities are driven by the weather, agricultural commodities in particular, or emerging market fixed income unconstrained strategies to really take advantage of idiosyncratic opportunities as they arise.
OK, so those are some of the ways to diversify the portfolio, given the risks that we're seeing in the broader markets. Frederique, how are you thinking about Europe then? That divergence story has been there. In recent days, it started to wane in terms of the divergence between European stocks versus their US counterparts. How are you thinking about playing the tariff risk versus the fiscal impulse of a rearmed Europe?
So at the moment, we still think that the fiscal impulse will outweigh tariff worries. But of course, unbridled enthusiasm has really given way to some skepticism with respect to the implementation of these very ambitious plans, and with good reason, because these very large spending programs often run the risk of running behind or delays and perhaps misallocation of fund. However, having said that, we think that the overall direction that Europe has decided to take is very promising. And while the lack of investment used to really, and the lack of growth used to really hold back investor interest, we think that the fiscal impulse has really changed the story. So we would not look at where the index might be, but we would really focus on stock picking for that region in particular. Being selective is very important. And we look for global leaders who happen to be listed in Europe in technology and healthcare in particular.
OK, technology and healthcare in Europe. Frederique Carrier, Head of Investment Strategy at RBC Wealth Management, with some analysis and views on how to position given the volatility that we're seeing across global markets. Thank you for the insights. Coming up, Bloomberg learns that Howard Lutnick signalled he may withhold grants promised to chip makers to push them to invest more in the US. We bring you the details. That's coming up. This is Bloomberg. Bloomberg's learned that US Commerce Secretary Howard Lutnick could withhold promised CHIPS Act grants as he pushes companies to expand projects in the country. Sources say Lutnick's goal is to generate tens of billions of dollars in additional investment without increasing the size of federal grants. He wants other chip makers to follow. TSMC, which recently announced a new $100 billion investment in the US. Coming up, as travel stocks slide in part due to a creaking US consumer, will tariffs hit the sector even harder? We're going to speak to the CEO of one of those biggest hotel chains. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bloomberg learns US car makers are making a last-ditch effort to avoid tariffs on low-value auto parts. Donald Trump's so-called reciprocal tariffs plan set to be announced tomorrow in the White House Rose Garden.
The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Turnaround Tuesday, Asian shares gain, bouncing back from a multi-day sell-off. But US futures drift lower after closing out their worst quarter since 2022. Plus, a 5-year ban on running for office for Marine Le Pen. President Trump expresses support for the French far-right leader, calling her conviction a, quote, big deal. European futures then set for a slightly more positive session, it seems, flagging gains of 0.4% after losses of 1.5% on Monday for European stocks. The volatility and uncertainty, of course, around the tariff regime is still there. FTSE 100 futures pointed to gains of 36 points, higher by 0.4%. S&P futures after the choppy session of yesterday, pointing lower by 0.2%. NASDAQ 100 futures also lower by 2%. US stocks having their worst quarter compared to the rest of the world since 2009. Flip the board and have a look across our set as we lead up, of course, to, those reciprocal tariffs stateside. A focus on the yield curve as well. The benchmark 10-year currently below 420 at 419, relatively stable so far in the session. Euro dollar out 108. The dollar having its worst start to the year since 2017. Brent is 75, close to $75 per barrel, up 0.2%, and gold at a fresh record, gaining 0.7% again in the session, closing in to 3,150. Now, as Canadian travellers shun the US in favour of East Asian destinations like Japan, China and South Korea amid those trade tensions with America, what will the impact be on the tourism industry as President Trump's tariffs take hold? For that conversation, let's bring in Oliver Crook, who's standing by with a guest for us with an insight on that sector. Ollie in Berlin. Take it away.
That's right, Tom. I mean, it seems that sort of everybody is being affected in different various ways by the Trump administration, and we're sort of gearing up for the summer season, which of course is the high season here for Europe in terms of travel destinations and hotels and of course airlines. So we're very pleased to be joined by the CEO of Accor, Sebastien Bazin. Thank you so much for joining us here in Berlin today.
Guten Tag.
Guten Tag. So as we face the summer season, we start to get a little taste of it these last few days, the sunshine. What is the picture for the sort of consumer and demand amid all of this huge uncertainty we're seeing across the world? Is it still positive for the tourism sector? Are you starting to get a little worried?
It is positive. You know what we had for the last 3 months, the last 90 days? It's a pure replica of the strength of the last quarter in 2024. So we're being up like 4 to 5% RevPAR in the end of 2024, which was unexpected, stronger than we felt. And we have kind of the same beginning for the first 3 months of the year. So it looks pretty good, very solid, despite geopolitical decisions. Summer, what we forward booking for this summer is strong, probably 3 to 5%, and maybe better depending. Paris is going to be very strong. But we see a pretty strong deceleration cross-Atlantic. So the forward booking from European travelers going to America, minus 25%.
In the first quarter?
No, for the summer booking.
Oh, for the summer bookings.
It's minus 18 to 20% for the last 90 days. What's my?
And what do you attribute that to? Why do you think that is?
Probably people deciding to change destination to go to Canada instead of going to America, or to go to South America, or to go to Egypt. It's just probably anxiety to go on an unknown territory, even though I'm encouraging everyone. I want to welcome all the Americans. Please come to Paris, come to Europe. You're going to be more welcome than others, and I'm sure the European will be welcome in America.
Do you think part of that is the fear that we've had some number of reports, high-profile reports in the United States, where you have tourists being detained now at the border for up to 2-3 weeks sometimes?
Yeah, I think it is totally anecdotic, so probably 12, 20 people. Yeah. But being anecdotic, it obviously creates a bad buzz, and you don't need any bad buzz today.
And in terms of the sort of currency exchange rate, this is another thing that's been fairly unstable in the last sort of month. Year to date, the euro's up, I think, about almost 5% versus the dollar. How is that affecting, you think, demand here in Europe?
Well, it's when we had a strong dollar, clearly we've seen it in November, December. A lot of Americans went to Paris. Would that affect a lot? If you're in between the 105 to 110, you won't have any noticeable effect. Probably better effect between the Canadian dollars and US dollars. But, you know, I've been CEO for the last 12 years. I'd never think about currency. There's so many things I don't control. This is one of the worst I don't have any control over. So I'll adapt to currency effect.
And then to sort of understand, broadly speaking, because you have such a global business, such a global footprint, what is the absolute strongest market right now? Where are you seeing the sort of greatest euphoria across the world?
Well, first, everything is pretty solid across the world because you have basically a demography which is rising, emerging middle class rising, and you have means of transportation rising. This is what I need for the demand to be sustainable. And it will be sustainable for the next 10 years, the next 20 years. We're in a blessed industry. Summer now, the boom is Southeast Asia, Laos, Vietnam, Cambodia, Indonesia, Malaysia, Middle East, Egypt. So this is where we see like a very strong double-digit growth, and in some cases above 20%.
And then there's another sort of a part of the world that's being affected, and the corporate world that's being affected, we understand by Donald Trump, is that we've started to get letters out from the U.S. Embassy in Paris to a number of different French companies, basically imposing upon them dissolving sort of DEI initiative, that sort of thing. How do you, as a sort of CEO of a major company that needs to operate globally, kind of deal with those kinds of pressures? I gather you have not got a letter at this point.
Not that I know of as of this minute, and whether I expect to have it, we'll know soon enough. You know, when you run a European headquartered in Paris company, you just have to live by who you are and your bylaws and your purpose. The purpose of Accor is a lot about people, culture, human interaction, and diversity inclusion is part of it. So we should not be budging. This is part of who we are, and we're proud of actually going that way. And it's not discriminatory at all. It's just.
And I'd like to also talk about the sort of luxury trade, which is an increasingly crowded space, I think, for tourism. And what you have now launched, I guess as of today, is the maiden voyage of one of the Orient Express trains.
Go to Italy, go on Dolce Vita, Orient Express, wonderful train.
So talk to me a little bit about how it is moving from the hotel industry into the sort of train industry and kind of launching this extremely high sort of luxury
yacht.
Then the yacht as well.
Well, it's all about, the more you travel, the more you want to have memorable memories, you want to have a feeling, a sentiment, and a reason to go back. So it's all about what you're going to be discovering. So, and people want a 360 experience. They want to be out of the world of the hotel, which people forgot about it 20 years ago. Just don't kidnap that guy within your F&B because he won't stay with you. He's going to go and dine elsewhere. And so the train, the hotel, the yacht is the same customer will probably do a 10-day journey, and he's going to go on a train to Rome, and he's going to spend 2 days in a Rome hotel, and then he's going to go on a yacht to go to Croatia. And it's quite fun. And you're going to remember that trip for the rest of your life.
And sort of two final questions. The first is basically how different is it running the train business, the hotel business? What have you personally learned about kind of the things that come
I learned that I guess I should have gone in vertical, I understood. It is a super complex industry. Train probably more so than the yacht, because the yacht you have a lot of expertise still being built for the last 20 years and still existing shipyards. Train, when you deal with European railways, they don't like each other. You need to get the certification. It's super complex in terms of logistics, in terms of getting the right to go on the routes, in terms of timing. But it makes it barrier to entry is humongous. So we're going to succeed. We're succeeding. Well, other guys going to be hesitating.
And finally, how much is it going to cost me to spend 10 days on the Orient Express?
It's not expensive. It's a lot of money. So if you go on the Orient Express, it's probably $8,000 a night. If you go on Dolce Vita, it's like $5,000 a night and rising. And if you go on the yacht, it's $10,000 a night.
Right. Well, Sebastien, Bazin,
but it's worth it.
So much. I'll have to take your word for it for now. Thank you so much for your time. The CEO and chairman of Accor, there for everything from the sort of luxury trade, which is still, Tom, apparently still in full effect, but also, of course, the Trump administration and the various impacts that's having for business across the world.
Yeah, I mean, the line that stood out, as well as you, of course, booking your next holiday, Ollie, was that 25% drop that he sees in terms of European travellers to the US. That's pretty marked, isn't it? Bloomberg's Oliver Crook with that interview, of course, with the CEO of Accor. Great stuff, Ollie. Thank you. Some lines crossing right now when it comes to the car maker. Well, in fact, the electronics good maker as well. They pushed into cars in recent years. Xiaomi, that stock dropping 4% right now in the session. This on reports that the police are investigating a crash involving a Xiaomi SU7 vehicle encountering a serious traffic accident on an expressway. And the shares dropping on the back of that. Some of the higher-end SU7 cars produced by Xiaomi do have an autonomous driving function. So no doubt the authorities will be investigating that as well, if indeed that was initiated. That detail still not clear yet, but it does have that ability if it's one of the higher-end SU7s built by Xiaomi. Shares in that company dropping on that news. Now, food inflation. Switching focus. Food inflation in the UK has hit a 9-month high as the government faces growing political pressure over living costs. The British Retail Consortium says food prices climbed 2.4% in the year to March, faster than the 2.1% increase previously, driven by rising prices, of course, of store cupboard staples and alcoholic drinks. This as households face higher costs for energy, water and local taxes, with the energy price cap being lifted from today. Institutional Shareholder Services, ISS, is urging investors to reject Goldman's $80 million retention bonuses for its top two leaders at an annual meeting. In a note to clients, the proxy advisor criticised the incentives for CEO David Solomon and President John Waldron, accusing the board of, quote, poor practice for adding new incentives before a prior programme is finished. The board has defended the bonuses. And US President Donald Trump says he expects Russia's Vladimir Putin to follow through on striking a ceasefire agreement, while accusing Ukraine of attempting to negotiate an economic deal with the US, renegotiate an economic deal with the US. It comes after the US leader threatened to impose secondary tariffs on Russian oil.
Briefly on President Putin, you said over the weekend, or indicated over the weekend, some frustration with him. How serious are you about imposing oil sanctions?
No, I want to see him make a deal so that we stop Russian soldiers and Ukrainian soldiers and other people from being killed. But mostly it's Russian and Ukrainian soldiers. I want to make sure that he follows through, and I think he will. I don't want to go secondary tariffs on his oil, but I think, it's something I would do if I thought he wasn't doing the job.
OK, for more, let's bring in Bloomberg's EMEA News Director, Ros Matheson. And Ros, we had you on the show yesterday. We were talking about the pressure that Trump seemed to be putting on Putin, arguably for the first time in that kind of manner. Now it seems that the pressure is back on the Ukrainian leader. What is our understanding of how this dynamic is playing out?
Well, that's right. So just wait 24 hours and the tune changes again. But as you saw, he's now been criticising the Ukrainian leader, Volodymyr Zelensky, saying that he's dragging the chain on this investment deal. What we know from our own reporting is that the draft of the deal really, in effect, ceded a lot of control over Ukraine's economy and investment future to the US. So the Ukrainians are looking at that draft deal. They're sending it back with their own requests, including that the US put in more investment itself, because right now it doesn't seem to involve any US investment. So obviously that negotiation is going on, and that, of course, is going quite slowly because it's a massive deal to sign for the future of Ukraine and its economy. And so now Donald Trump is turning his attention there. But again, it's the same thing that we've talked about before, that sense of frustration. Hang on, I wanted to get to a full ceasefire here and I wanted to do it fast. I've got Ukraine, arguing over this investment deal. I've got Vladimir Putin seemingly going quite slow on some of the conversations, so we don't really have any negotiations yet about a full ceasefire on the ground in Ukraine. It's the start of April, and there's nothing that much to show for it. So it's really about Donald Trump being frustrated at the pace of things and urging both Russia and Ukraine to speed up.
And meanwhile, we're getting details from President Trump about his potential first foreign visit in his new presidency, his second term, of course. What do we know about that planned visit?
What he's talking about is going to Saudi Arabia, possibly next month, but also floating that he might tack on the UAE and Qatar as part of that. It's interesting that he chose that region for a number of reasons. One is that, of course, like Saudi Arabia, the UAE and others have been very quick to promise to be sending a lot of money in terms of investment into the US. They've read the room very carefully on that and very quickly. And so they're promising substantial investments into the US. So perhaps a chance to pin some of that down, but also to say thank you to those countries. But, may possibly for the Saudi Arabia visit, is that out of the realm that we could see a summit there between Donald Trump and Vladimir Putin? I mean, Saudi Arabia has been talked about as a possible host for that summit, and that's where the Russia-US and the US-Ukraine talks have been going on. So it's not out of bounds that maybe if things do progress, that they feel at the point that Donald Trump does want to sit down directly with Vladimir Putin that could serve a double duty. One is to spend time with Saudi Arabia, the UAE, and Qatar, and particularly the Saudi, de facto leader Mohammed bin Salman, who's a key player geostrategically in the region, but also sit down with Vladimir Putin.
Yeah, and a leader who's playing that kind of neutral broker role. At least that may be how they characterise it in Riyadh. Ros Madsen, thank you very much indeed on the details of what could be the first foreign visit by President Trump in his second term, of course, and the latest when it comes to his views on both Ukraine and Russia as he continues, of course, to push for that ceasefire. Coming up, we are going to switch focus to artificial intelligence, rapidly advancing, of course, continuing the innovations on almost a daily basis. Regulators, meanwhile, of course, struggling to keep up with the pace of that innovation. We're going to bring in the views of Bill Connor, CEO at Jitterbit, a leading cloud-based API integration platform with something of a global reach. That conversation coming up. This is Bloomberg. Welcome back now. As AI models like DeepSeek and Manus emerge from China, there is, of course, growing concern over securing national interests. This as AI models controlled by foreign governments pose broader security risks, at least that is the view from some. For more on this, and of course the demand for how AI is being adopted across the enterprise space, let's bring in Bill Connor, CEO of Jitterbit. It's a company that focuses on provides a platform for integration and app development automation for enterprise clients, and it's got that global reach. Bill, thank you for coming into the studio. Good morning. What are you seeing in terms of demand for Jitterbit products in an environment where growth is slowing and we see those geopolitical overhangs?
It's really interesting. Enterprises are looking at AI two ways. One, for productivity gains, but also to make a difference in the business. About 99% of the companies had an AI project. Unfortunately, about 85% of those didn't have a great outcome. And it's interesting when you start looking at it, about 50% of them are concerned with security, your opening comment.
Yeah.
And a third are looking to the future like Agenix, where AI is kind of next generation.
So is there a bit of a mismatch between expectations and being able to deliver on the bottom line?
Yeah, I think people looked at AI as a silver bullet technologically and just wanted to deploy it. Where we're seeing businesses think through what they want to use it for and how to use it to change their business, that's where it's being successful.
I want to get onto the cybersecurity piece, but before I get there, what are the priorities for you in your leadership role as CEO in terms of growth of this business?
Yeah, it really was important for our customers to have an evolution. We're a low-code software platform, meaning it's not the old code, it's kind of halfway between it. AI gives an opportunity for now not just highly technical people, but line of business or business experts to use AI to do what they can't do because they're not coders. So our whole focus has been infusing AI into our code so the customer can go either way.
And what enterprises, what industries are proving the biggest upside in terms of the growth potential?
I think every industry has unique opportunity to take advantage of. It's just different if you're in travel, which our last person was, or if you're in manufacturing, or if you're in retail. And I think that's the point.
Okay.
If you try to apply AI just as a tool, you're going to have failure usually. If you try to apply it for where you need the business change and process improvement or less skill, that's where you're going to be successful.
So you've got to be malleable in terms of how you apply this. Just given your background in cybersecurity, who wins? What are the hackers doing with AI tools? And does cybersecurity and defenses, who wins the race in terms of the catch-up between deploying AI as a hacker versus those securing these systems?
Well, it really is a cyber arms race, right? Both for good and for bad. The bad guys now can use it to look for exploits that are a lot easier to find with AI tools than they were before. The good news is the good guys are using it to help protect against those holes that they might not have seen before.
What do you see in terms of the jobs impact, briefly, Bill, before we let you go? Do you see, internally at Jitterbit, are you going to see a reduced headcount as you push out, as you integrate AI into your own company?
I think you will see reduction in people in certain areas, but what you're going to see is more productivity and a different resource that you can take advantage of. And why I mean that is because literally AI will take over some rudimentary things, but it's going to allow all of us to be a lot more productive with our day job.
Okay, Bill, thanks for coming into the studio.
Always a pleasure.
As you visit, of course, the team here in London, then and move, I think, on to Germany before you head back. Bill Connor, CEO of Jitterbit, with the focus, of course, on AI integration and trying to close that gap in terms of the mismatch that we're seeing in some areas in terms of expectations of what it means for the bottom line. Meanwhile, SoftBank is said to be seeking a loan, staying on AI, a loan of as much as $16.5 billion to help fund AI investments in the US. Sources say talks with banks are in early stages for a bridge loan with a tenor of about 12 months. We're told the money may help SoftBank lead a $40 billion funding round for OpenAI, valuing that company at $300 billion. There's plenty more coming up. Stay with us. This is Bloomberg.
Everybody's looking for like a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative.
Morgan Stanley's chief US equity strategist Mike Wilson speaking there, with, of course, the focus on tariffs as we lead up to the decision tomorrow from the White House in the Rose Garden. Here's the view in terms of where we could end up. Tariffs right now, broadly across the US on goods coming into that nation, currently at around 10.75%. That's where we're at now, already at the highs that we've seen. Already, you had to go back to World War II to see these kind of levels of tariffs that are already in place. Where you get to, depending on the different scenarios, but this is the calculation from Bloomberg Economics, potentially is a tariff of 35% on average across imports into the US. 35%. So that's well above what you saw even in the 1930s on that Smoot-Hawley Tariff Act, of course, and that would be unprecedented if, of course, that scenario comes to bear from Bloomberg Economics. Let's flip the board and have a look in terms of how this is all impacting views on the US stock market, of course, given that challenge quarter that we've just seen. You've seen David Costenome at Goldman Sachs reducing his target for the S&P by the end of the year. Again, he did it twice in March, now to 5,500. Again, flagging recession risks, flagging the tariff risks as well. Citi, by the way, suggesting, in fact, RBC Capital Markets suggesting that if you get below 5,500, you could see a 20% reduction from the February highs for the S&P 500. Let's flip the board and have another look in terms of how things are shaping up on the earnings front, because what a different story we're looking at this year in terms of earnings expectations. The yellow line is Europe. Look at that. Earnings expectations for European stocks outstripping those, of course, of the US. We'll see, of course, and we'll get the details on that when earnings season kicks off. Part of that, of course, down to expectations that fiscal stimulus from nations like Germany will prove supportive. There's plenty more coming up. The opening trades is up next. Stay with us. This is Bloomberg.